What is it? Well, it is a 25% credit on Minnesota personal income taxes. Its purpose is pretty simple. The legislature, it was part of a larger jobs bill that is intended to create and incentivize the private sector to create jobs in Minnesota. The benefit comes to businesses who will be able to get capital they need, to investors who reduce risk, and to the general public, the state community for creating jobs and keeping economic activity in Minnesota. The credit is refundable but not transferable. So if the credit exceeds tax liability, people can apply for a refund. That also means that those who do not have Minnesota liability or don't live in Minnesota are also eligible. The legislature is making this available to import capital into Minnesota, which we're excited about. The maximum credit for an individual is $125,000 a year, $250,000 for a couple filing jointly. We have an allocation of credits of $11 million in 2010 and $12 million a year in 11, 12, 13, and 14. Except in 13, there's $100,000 appropriated for a study to determine if it's working. So over the life of the program, we have $58.9 million in credits, and we'll need about $240 million in investments to fully allocate the credits. In private life, one can do anything that isn't prohibited by law, or should if you ask only those things not prohibited by law. In government, we can only do what's authorized by law. And so the authority for this is in the laws of 2010, Chapter 216. There are a couple areas where we can interpret the law. The law was carefully written and the language is plain, and there may be, as Senator Saltzman said, if there's some things that are a little bumpy, we'll need to go back to the legislature. But our job indeed will be to administer this according to the law. Let's start with investors. People who are qualified to invest must be a natural person. So C Corp, for example, will not be eligible. They must meet the SEC definition in Reg D of an accredited investor, which is a little more complicated than what I'm going to say, but it's basically a net worth of $1 million or $200,000 of income for an individual, $300,000 for a couple filing jointly over a period of 2 years back and certified for 1 year forward. Or non-accredited investors can invest in qualified Minnesota offerings under Minnesota securities law. The investor does not qualify if he or she receives more than 50% of their annual gross income from business. They must be certified by deed before the investment. At the end of this presentation, we have sort of an order of what has to happen. The minimum qualifying investment for an individual is $10,000, and an investor's certification application will be on our website by the 1st of August. We're going to beat that by some, but no later than the 1st of August. Watch for it starting in July. PositivelyMinnesota.com/angel. Funds have to have a minimum of 3 qualifying investors. They have to be organized as a pass-through entity. The investment has to be in equity or interest-bearing notes. They must be certified by deed prior to making the investment. The minimum investment for a fund is $30,000. And the fund certification application also will be on our website by the 1st of August. Qualifying businesses is a little more complicated, but not a lot. The headquarters has to be in Minnesota, obviously. 51% of the employees and 51% of the payroll has to be in Minnesota. The company has to have, at the time of certification, fewer than 25 employees. It has to pay every employee at least 175% of the poverty level for a family of 4, which is currently $18.55 an hour. And that can include benefits. So if it has a cash wage of something less than that and a reasonable value of benefits, the total is $18.55. That meets the law. This is not average. This is all employees. It is can't have been in operation more than 10 years, and prior to certification cannot have raised more than $2 million of equity. The also cannot have been disqualified under Minnesota statute 88.50, kind of the securities bad boy provision. He is not eligible to generate more than $4 million in investments after certification that are subject to the credit. The credit is maximum for a company is $1 million, 25% credit, $4 million qualifying investment. It has to be certified by deed before the investment is made, and the certification again will be on our website by August 1st. What kind of businesses qualify? Well, the critical thing is proprietary technology in a high-tech field, innovative technology. It can be currently in existence, has to be protected by patent, copyright, patent pending, patent applied for, and it can be for the development of such property. The fields are fairly broad as to what it can be, what fields of technology can be in. It is, in fact, I'm not going to read this to you, but what it can't be in is almost more inclusive. The application of technology to a wide variety of fields, including human and animal health, information technology, veterinary medicine. It's the list that you see on the screen, and it's also on our website. The legislature also, in my opinion, very helpful, made very clear what's excluded. Does not include real estate development, insurance, banking, lending, lobbying, political consulting, IT consulting, wholesale trade, retail trade, leisure, resorts and golf courses. No stadiums, ballparks, arenas, or auditoriums are allowed, and that's broadly across the whole jobs bill, not just this provision. Doesn't include hospitality, transportation, construction, ethanol, cornstarch, or professional services as listed here. Cellulosic ethanol, which could include things other than cornstarch, are eligible, but because it's considered an existing technology for a wide variety of reasons, starch ethanol is not included. The tax credit has a fairly robust reporting requirement, so that we can both let taxpayers and legislators know that we're getting our money's worth. Individual investors, funds, and accredited business must file annual reports. Investors and funds must report for 3 years. There is a $100 in. There are fees for a lot of these things because that's how the administration of the program is paid for. The legislature didn't appropriate administrative dollars. So there's a $100 annual reporting fee, for example. Companies to be accredited, there's a $150 fee. Individuals is $350, and funds are $1,000. So it is not a fee-free environment, but it is sufficient that we have a fair amount of administrative obligations, so that's why it's done this way. And there is also a fine for failing to report of $500. Now, most important thing probably is the holding period. Well, that's not in this slide. Let me get to that. Individuals, investors, and funds. All right, investors and funds have to apply for annual certification. And you get certification in the year they're making an investment. Businesses apply for annual certification in the year they're receiving investments. And then business investors and funds jointly apply for a tax credit allocation for the proposed investment. And we will, with the Department of Revenue, issue a certificate entitling you to that credit that you'll file with the appropriate form to either get a credit against the taxes or refundable, you get a check, essentially. Jeff Nelson, if you would stand up. Jeff is the administrator of this program. His credits are, or his contact information is here. Everything that I have said is on our website at positivelyminnesota.com/angel. Or is it Angels, Jeff? Angel Credit, thank you. I not only don't look good, I have a little trouble reading the fine print on the monitors now. The holding period is important. The holding period for investors is 3 years. The year of the investment plus 2 additional years. And there is a clawback if you don't hold for that long. There are some exceptions if the company is sold or goes public or 80% of the assets are sold. There is a 5-year reporting requirement for companies, and companies need to stay in Minnesota. I think 51% of their employees and payroll in Minnesota. If they fail to do that, then the company that receives the investment has to pay back the credit. So there's a fairly robust clawback for companies that decide. It will mean it would have to be highly beneficial to move someplace. We want to keep these jobs in Minnesota. And so that's